So, welcome to Power Pulse with your host, Udodiri Elizabeth, a realtor from Keller Williams. Today, we have two wonderful speakers who have been in the finance business for years. One of them is Mr. Akeem Adebisi from AjoPro, is a financial expert. Then we also have Mrs. Habeebat Adeniyi, a mortgage specialist. And today's topic will be from funding to mortgaging, how AjoPro and mortgage financing power real estate success. We want to actually talk about finance, what we need to know in terms of finance that will lead to the success of mortgaging property successfully, whether on the buying side, selling side, or investing side. So I would like our speakers to introduce themselves. I will start with Mr. Akeem Adebisi. Thank you. Then, Mrs. Abibat, please can you tell us about you?
Good evening. In fact, this is beautiful, and thank you so much, Elizabeth, for putting this together. My name is Habeebat Adeniyi. I'm a mortgage broker, and I've been a broker for close to 8 years now. It's been an amazing journey, but I'm looking forward to what the questions and how the thing is going to go this evening. Thank you.
Awesome. Thank you so much for the introduction. Now we'll dive into the questions we have for today. The first question will go to Mr. Akeem of AjoPro. As you can see it on his shirt, bold. Now, what is AjoPro and how does it help people to access funds for real estate?
It's a combo question. So
Yes.
put together, right? So let me say this. Let me say it this way: AjoPro helps people plan and access funds in a structured way without relying on traditional debt. So instead of reacting to financial pressure, we enable our users to prepare ahead for major purchases like real estate, for example, while mortgage financing completes the journey by providing the long-term funding for ownership. So basically, AjoPro is a purchase planning platform that allows users to build towards goals like
So it's
home
sort
ownership.
of help them to start the beginning aspect of it.
Exactly.
When you say beginning, what do you mean?
So think about somebody who wants to buy a house, like we just talk about a house, right? One of the very first thing that we ask them to do is to plan buying it, right? When you plan, you reduce cost for yourself and you reduce pressure on yourself, right? So think about somebody who wants to buy a house. You know that you want to buy that house at least 1 year earlier. If you take that 1 year to plan, you can actually plan 20%, not even 5%. Now imagine if you pay 20% down on your house. You've reduced costs, you've reduced pressure, and so much thing on yourself. So yeah.
Thank you for analyzing it, because when you say 5%, 20% in my head, I was like, okay, when you say 5%, is it the planning side? Okay, now what you mean is the down payments of the
Exactly.
5% and the 20%. And
Exactly.
really, in real estate, when you pay 20% down payments, you've actually covered so much. Mrs. Abibat, is it?
There's a lot of equity that is already in the property already. So you've
Awesome.
already put enough down. And guess what? You will not be paying something that is called CMAC, Canada Mortgage Housing Corporation. That's because that's an extra 4% on the first mortgage that is going to go on. So if you pay 20%, yes, it's ideal to pay 20%. But if you don't have, then you don't have to go and break the bank to. That is why government said you can do as low as 5%, then that should be fine. Yes.
Wow, this is really awesome to know. Now, my next question, it still goes to Mr. Akeem. You know, what you just said is interesting, and I believe it's going to catch the listener's attention. So, how is AjoPro different from traditional saving or borrowing method? How is it different? Yes, because I've had so
Okay.
many people ask me this question. When I tell them AjoPro, they like, what is this? What are you telling us? Are you trying to scam us? Have you come again with this community stuff?
Fundamentally, the difference is in the finance classification.
Beautiful.
And that's a big grammar, but let me break it down.
Thank you.
You see, when you save money, right? Saving is static. It's something that you're just putting it there. You know, if you look at any smart investor, they will tell you saving is not investment, right? Because they know when you are saving money, you are fighting a lot of hurdles, because when you save money, you are saving against inflation, right?
Yes.
So at the end of the time, at the end of the day, the money that you are saving, inflation kind of reduces it, right?
Yeah.
So if you are not careful, you find yourself in a situation where the money you save is less than the value that you had before, right? Because of inflation. So that's why AjoPro is totally different from saving. So saving is static, is slow, is rigid, does not grow, it's just there. What AjoPro does for you is completely different. AjoPro, the money that you put in AjoPro has 3 legs. Number one, that money itself grows in value over time. It's not like we are giving you interest. So let's take it. It just grows in value, because think about it. If you put 500 this week, you put 500 next week, that's 1,000, and so on, right? It keeps growing. Okay. But not just ordinary growing. It grows in time value,
Time value.
which is the reason why you have inflation, right? This is what helps you to reduce inflation. So inflation is about time value of money. So our AjoPro money grows in time value, which means it takes care of inflation for you automatically. That's number one. Number two, as that money grows, it actually reduces what we call your cost of access. So let me explain that. If somebody is doing 10,000 in AjoPro plan, if you take number one, say you are going to pay us $1,000, for example, right? In the costs of accessing that money at number one. If you wait for number 7, you are probably paying $100. So you see, because you are putting the money there, you are reducing the cost of access. So your cost of borrowing is going down every time you put that money there. That is true. If you put your money in savings, it doesn't reduce your cost of borrowing. It doesn't in any way. But in AjoPro, as you put that money there, it reduces your cost of borrowing as you wait. That's number 2. Number 3, there's one thing we call the so I'll talk about the cost, talk about the growth in value, right? There's one more part again that AjoPro do for you. When you put that money there every time, what it helps you to do is it increases the value of that money. So in AjoPro, for example, if you take number 1 on 10,000, you take 10,000 actually. But if you wait for number 2, you take 10,000 and $10, 10,100. So the money has increased, right? If you wait for number 7 as an example, you might be taking 10,600 and something. So the value of the money is growing. The cost of accessing the money is reducing. That is totally different from savings, where it's just static. You're just putting your money there and you are running your money against inflation. So it's different.
Wow. Let me 1 second, Elizabeth. So, because a layman, back home, we are from Nigeria, right? And we have something we call Ajo, right? And most people would just be like, oh, what's because the difference between our normal Ajo, our Ajo is just like, oh, this month is my turn, and that month is your turn. We are 10 in number. And, and which I know in the finance world, you cannot use that for your down payment because they see it as a pyramid scheme that cannot be used. But people comes to me and said, "Oh, Ajo, Ajo." I said, "It's different." So can you put in the? I know you have explained, or just put it in a way that we know that AjoPro is. We know it's supersede our normal contribution Ajo.
Let me come in. We still have lots of questions, right? So we're taking everything one step at a time.
Okay.
What you're saying is beautiful, and that is why we are here today. We want to actually analyze these two, how will I put it, these two entities, and how it helps people in real estate. What you said is very good, but he can go ahead and answer it, but expect the same question along the way again.
Okay. Okay.
Thank you.
Move on.
Which are going to get there.
No, let's just say it now. At least just go with the flow. This is
Okay.
interactive. Trust me. I love
Yeah.
it.
I know your question is around how AjoPro is different from savings, right? Which I've explained, right? But AjoPro itself is a totally different concept from the traditional Ajo. It is not Ajo. So I was telling my board one of these days that somebody asked me, why do we choose the name AjoPro? It's becoming a liability. I say it's not a liability. Is I want people to know that this concept came from Africa. It's important to me as an African man than to just call my team placard. It makes no meaning to me. I want to have that name associated to where I come from. But it is not Ajo. In Ajo, you have 10 people that come together. You give all of you put the money together and you give to one person. Now that's a very big problem because in finance, it is not Pareto efficient. Now, what does that mean? That means if all of you put that money together and give to one person and that person die, what happened to the whole 9 people? They are getting the problem now. Sometimes you say, oh, the person is not dead, but the person can just decide not to pay,
Run away.
run away, or lose his job.
Yeah, that true.
You
Lost
see?
his job.
So he
So
wants to pay, but he lost his
there is
job.
no there is no security to get the money back.
So Bank of Canada is not going to allow you to say that, oh, you have faith. That faith will allow them to leave. No, we're not interested in that. So
Money matter.
they want the money to be secure, right?
Okay, thank
So
you.
in AjoPro, every single dollar that you give is in a trust account. And the mortgage advisors and the lawyers know what they mean by trust account. It's an account that when you put money there, the only person that can take that money back is the owner. So in AjoPro, we don't take money from you and give someone else. No. If you have 2,000 in AjoPro and you want to collect 10,000, it is our money, our own finance capital that we give you. You get it? It's our own money that we are giving you. We are not giving you another person's money. So that's why our business we have two legs. Kumi is actually what does the contribution. That's what we call it planning. Financial is a company that many of you have not heard about. Pro Financial is the one that grants that money, that loan, that part. We don't call it loan because we've created an algorithm that take it to zero interest. right? So we don't call it loan, but we have a company called AjoPro Financial. Financial is the one that gives that money to support the Ajo. So you do Ajo, you do your 2,000, you need 10,000. We'll give you 2,000 from your trust account, and then we'll give you 8,000 from our own AjoPro Financial. And we take these two money in our control account to give it to you. So that is the way it actually works in a simple way.
Sorry. There was something you said in the course of this your explanation. You said Rakumi, and I've heard this Rakumi. Can you please explain Rakumi very, very well? Because me, the only thing I know of is AjoPro, AjoPro. Now I'm hearing AjoPro Financial, another one again. Oh, the analysis here is
Yeah.
it's
So
just awesome.
because we are
Okay.
a single company, most people don't really know the difference, right? Except people
Mm-hmm.
who are internally with us. So AjoPro, so Rakumi is our purchase planning tool, is our engine.
Rakumi, purchase
Is a
planning.
PSP registered company with the Bank of Canada. Okay, what it does is it allows you to plan. It's a planning layer. It's the infrastructure layer. It is what Government of Canada gives the registration, right? That's what it does. Now, that has a trust account. Everybody paying, you will see that when you go to download the app, you will see Rakumi INC. That means you are dealing with Rakumi infrastructure. Okay. Now, when you start doing it, let's say you started doing your money and you now do 3,000 and you now want to collect 10,000, you will see that when they send you contract to sign, you see AjoPro Financial at the end. So you now know that you are technically getting money from another company. But these two companies is owned by us. We own the two companies together.
So
But
it's
it
more or
has
less
to be
like two in
separated.
one.
So the one that is doing the contribution is the Rakumi. The one that is doing the giving you extra money that you need is financial. That one is doing lending business technically. Technically, it's lending business. But we have created this lending business in a simple way and created a simple algorithm that helps us to make your interest to go to zero over time. Yeah.
So that means it is two companies in one.
Yeah.
Wow. Wow. This is really, really, really helpful. And this is really, really lovely. So our viewers, our listeners, I would love you guys to take advantage of this great financial opportunity in terms of real estate to make that purchasing, selling, and investing easy. So if you want to connect to Mr. Akeem, all you have to do is just DM me, and his phone number, his contact information is one dial away. So he's always available to speak with you and educate you regarding this. So now we have to go to our next question. This is actually interesting. I love the angle this podcast is going today because even myself, I'm learning so much. I'm actually part of AjoPro, but the place where you've gone to tonight, I've not heard of them before. So it's my first time, and it's even making me to see more advantage of AjoPro. So thank
Yeah.
you.
Thank you.
Now we're going to go to Mrs. Habeebat.
Mhm.
What is mortgage and why is it important in real estate transaction? I know we've talked about this, but learning every day. So we can always learn from this one something different.
So the first thing I usually tell people is put the fancy word mortgage by the side, okay? And let's call it, what is mortgage? Mortgage is actually a loan. It's a loan. So normally I usually tell my clients that you are going into a huge loan. Are you ready for this loan? Mortgage is just a fancy word that, oh, I just got my mortgage. But trust me, you just got a big loan.
You all got a load.
And this big loan, you have to just make sure that you babysit this loan, like that you must make sure that everything that you're actually ready to go into this loan. It's more or less like a car loan. You know for sure you have to pay. Now, car loan you can do maybe 150, but this is a huge loan depending on your capacity,
Mm-hmm. Mm-hmm.
right? And this loan or this mortgage, you know what the bank does? It stands as a collateral that if in case you're unable to pay this loan or the house, right? So the house, the property you're buying is a collateral for the loan. And if in case you're unable to pay the mortgage, they can take back the house from you. And definitely that is when you see houses going in foreclosure because people are not paying. So that is why mortgage is a loan. Let's see it as that. And why is it you ask why is it important in a real estate? Trust me, looking at a mortgage of 600,000, me, I no get them for 600. How I wish, you know, how I wish. So if you can pay off your mortgage 600,000, why not? But because we don't have the capacity to pay it off, then that is when you go into something we call the mortgage. And by then you'll be paying instrumental. You know, when they pay like back home says pay small small, you have to start paying according to what your interest rate says, according to the policy, according to the plan that your commitment with your lender. So a mortgage is typically a loan that needs to be servicing. It could be whatever bi-weekly, depends on what it's on your commitment. And like I said, I usually tell people you have to be physically, emotionally, spiritually, psychologically ready to get this loan. And don't do more than you can. Because I've seen some, in fact, I'll give you this example. It's just a lovely lady that came to me and said, oh, I want to get a mortgage. And I said, okay, that is fine. She's single. And I asked her, okay, if you actually want to get a mortgage, like how much are you thinking of? He said, oh, auntie, I'm thinking around 500,000 mortgage. I said, okay, just you, single? How much is your income? Right? And she told me, oh, I'm doing two jobs and both is almost like 75,000. And I have a car loan. I said, sometimes it's a good thing, but you wouldn't want to discourage them. But I said, my dear, you're not yet ready. Because, yeah, I said, you're not yet ready. One, it's a whole lot. So when you think about it, think about I'm going into a loan just to have a clear picture and clear understanding of it. Yeah, so let me just
Add something to that.
Yes.
I think you've mentioned one of the most fundamental things that people miss, which is mortgage is a loan. Now, if mortgage is a loan, it's not only a loan, it's an amortized loan.
Yes.
Now, the biggest problem with this type of loan is that all the interest is always put forward. So in the first 5 years, you are paying the biggest chunk of your interest. So technically, maybe 80%, 70%, sometimes 90%, depending on the interest rate. The money that you are paying is going towards only interest. So you are not actually paying down on the mortgage, you are paying the interest back. They want to make sure they take their interest as quickly as possible. Now, here is the problem. For a mortgage of 500,000 that Sister Habeebat mentioned, you can literally pay close to $400,000 in interest in 25 years. So it's like you are buying another house completely for the bank after 25 years. So any opportunity you see to reduce that interest is important. And that is where AjoPro comes in. So think about it. If you don't plan with AjoPro, to raise that 10%, to raise that 20%, or that 5%, what do you think will happen? You go and borrow money again for that 5%, which some people do. They borrow the 10% or the 5%, then they borrow the mortgage. So what we are saying is, take your time. Like the lady you mentioned, if she takes her time to spend the next, 1 year, 2 years to plan getting 20%. I always tell people that if you cannot take money and plan, then you can't afford that thing. If that house is $1,000 monthly, for example, mortgage, and you cannot put $1,000 away monthly for 1 year, it means you are not ready to buy that house. So AjoPro would help them plan that. Imagine she has raised 20,000, she put 20,000 down. Imagine she got a good advice to reduce that 500,000 loan to maybe 350 in the beginning. Maybe instead of buying a new house, buy a used house, that turn that house into investment from beginning number one. That would have been helpful for her.
But there was this client, and they're doing on a monthly, and that's another thing. Your frequency payment matters a lot when you want to service this loan. There is this client, she came to me, our interest rate is around like 6 point something, and our monthly is around 2004. Guess how much is going to interest? 2,100. And 300 goes to principal. And I told her, I said, you know what? Stop, pause, and let's restructure this. You can do a bi-weekly payment.
Even weekly.
Weekly is the best. But the only thing is, are you able to keep up with the weekly payment? So, because most people, your bi-weekly is bi-weekly. So you know that the money comes in bi-weekly.
So before it comes, you are finished.
The best to pay your mortgage is weekly. The best. But bi-weekly, okay, we can still manage bi-weekly. If you now pay bi-weekly, you will still see it maybe in the course of the 2004. Maybe it will just be like slightly half of it. And guess what? And I said, okay, now I can get to a smaller interest rate. She got a smaller interest rate, right? On a variable. She restructured. On a variable, getting even way at half of what she was paying. And now we now structure it. Okay, you're comfortable bi-weekly, yes. And one goes, and guess what? Now paying 2,004 now drops to almost like 1,000 something. No, almost 1,000. Now, like 590 something goes to interest, the other goes to principal. And I told her, I said, see, common sense. You want to pay your mortgage as fast as you can, right? Now, you're comfortable paying 2,004. The 1,000, the extra, start putting it on your principal. If you have it, if you believe that I can do it, because you've been doing it for a couple of years, you're not complaining, you're used to that amount. So why not put the remaining balance and just put it on your principal? He said, oh, auntie, I can do that. I said, you can do perfectly. And that was what she started doing. And she was just like, oh, I'm even, oh my, this. I said, yes. So that is but the best payment is weekly. But can you put up with it? That is a question mark for us all, if you'll be able to do it. So I know we are time, and I know there's...
But no, this podcast is interesting. You know why? I actually had a different plan for the podcast, but the way the interaction is going, and from each discussion, question pop up.
Okay.
And these are real life questions, because we are trying to connect with what we've actually feedback we've gotten from people. So it's even making this whole thing interesting. Of course, we even have part B of this podcast maybe another time. So even if we don't finish the questions today, sorry, I'm still going to give another invitation. Hope both of you don't mind, because this angle we're going to is real life situation. You never know, you could be saving the future of a family with what you are sharing. Now, there is another question that came up in the process of you explaining mortgage and real estate. And this question came as a result of, I think, a transaction you and I worked on last year. I'm going to share this podcast with that particular client. So the question goes like this. It's actually two questions, but let me start with one. let's say I have a client that wants to buy a house, and a house of, let's say, 500,000. Is it possible for the person to pay the 500,000 complete if they have the money, or they still have to go through mortgage? Because that particular client was like, "Oh, I have the money to pay for the house." So we're like, "No, you have to go through mortgage." Or he was like, "No, he wants to pay everything, blah blah blah." But at the end of the day, of course, I'm not a mortgage expert.
Yeah.
I will not be the one to answer that question. So I would love you to answer that question for
So
me.
now
Thank you.
I remember that transaction.
Yes.
First thing is his status.
Mm-hmm.
What is his status in Canada? I think he doesn't have a status in Canada at
Yes.
that time. If
Hmm.
you have the 500,000, I've seen someone 250,000 mortgage, he paid it off. The only thing that they needed that is just a lawyer. No need for a finance because you've already
Okay.
paid it off. So why do you want to get a loan again? So there's no loan in this aspect. It's just that you have one-on-one with whosoever the rater and then your lawyer. That's it.
So
There is
that
no need.
means, sorry to cut you. So that means in the offer to purchase document, I'm still going to put a mortgage person, right?
No, there is no need.
No
There's
need.
no need because you won't
No
even
mortgage.
put a mortgage person on the offer because you know technically that this person is paying it outrightly. So what you need to do is just you as a rater that is representing him and the rater that want to sell the property, that is it. And put the lawyer that is going to finalize the process. That is just it. And everything stays with the lawyer. But mind you, this person, I've seen them. This person must have a status in Canada before they can buy. One, what is it called? Student cannot buy in Canada. Okay, work permit can buy, but it must not exceed 183 days. Status must not exceed 183 days, then you can buy. Sometimes lender may ask them to do 10% down payment. See, permanent resident has a very voluminous options when it comes to buying, selling, investing, and things like that because they are permanent resident or Canadian citizen. But when it's outside the box of it, then they can come. Visitor cannot buy, right? It's just visiting because they do not have any status. Then they used to way back
Yeah.
then
They
that,
changed.
oh, my son
My
is
son is
here
going. Yeah.
as a student and
Mhm.
parent wants to buy. I've done it. And parent came in here, bring money from Nigeria, put it down for 3 months, and pam, we did the transaction, but not anymore. So status matters before you can buy in Canada. You can investors. There are some people that will just be like, oh, I have investors visa or something like that. They are different aspect of it because they are investing. I have an investor. He bought, I think, but during the time of doing the process, they are less than 4 months and they did 20% down. See, I love when doing 20% application is the most simplest of all the application. You see this 5%? Jesus. We need to do it, but trust me, 20% lender is more comfortable and relaxed. We have some, I think it's just one lender that does 15% without no CMHC. 15% down payment, but remember, their interest is slightly higher compared to the normal one. This is a special, that is from another lender. It's not too many lenders does that. So they have an high ratio special treat for 15% down, and that will not include CMHC. So it depends on case by case. When you're treating an application, I've never done an application that is the same. So it's case by case. And I won't say, oh, yes, I can do it. I have to review. I'll see what you have. Some people will tell me, oh, my credit is good. My this is good. Yes, it's true. But by the time you do the pulling and everything like that, then you see it differently. So it's case by case when it comes to buying, but you can buy outrightly if you have the money. If you have 600,000, Elizabeth, and you know where our chairman can buy, you know, he will just say, I'll be back, don't worry. I'm just, the only thing for me is you are not going to make me to eat. I know I need to eat. You know, that is just because you don't need a mortgage broker in the process anymore.
I see how excited he got when you said you can pay outrightly. He got energized.
That yes, I like the flow.
My neighbor here, right,
Yeah.
paid his own outrightly,
Wow.
$750,000 cash.
Wow, 750 cash.
We'll get there.
I love that.
We'll
I
get
love
We'll get
that.
there over time.
I am
We'll
tapping
get
into that particular method
there. We're
of
walking towards that area.
yes.
Yeah, we'll get there. So you seem to have another question. You said it's just
Yes. You talked about restructuring of loan, mortgage. Could you educate us more on restructuring of mortgage? Based on that lady's situation that you analyzed, you may be
okay.
able to get her rates down and
Okay.
all that stuff. Yeah.
Okay. So this is the thing about it. When you come to me, like I said, I review first. I won't give you my words in the first place, right? By the time I review your documents, so she came to me. She was currently with one credit union, and I told her, I said, okay, let me review and analyze what we can do in order for your payments to come down. Because even though the 2004 and 2001 going to interest is way more, it's too much. Then I now sat with her. Fortunately, she did not incur additional loan during the process. One thing about people is by the time they get mortgage, they will pull up extra loan, meaning that they will go and get 6,000, 650 or 65,000 car loan, maybe two. They will line up credit because we want to do our basement like that. But for our case, she was so mindful of additional loan. So her income is flexible in the sense that she can move anywhere. If you're stuck with a lender, because you're stuck because you have too much of debt and you cannot move because there is nothing you can do. You can't move because your income will not be able to shoulder the mortgage and all the loans. Okay. So right now, the lady was so mindful because in her head, she knows that at one point she's going to move out of what she is. So when I start with her, did a Zoom, and I explained, and this is one thing I usually do. I do a Zoom call with my client. What the application I'm using to do their mortgage application, I share my screen. So they see visually at the back end that this is how this is going. So during that time, I was able to move her to another lender because our income can still shoulder all our liabilities, including our mortgage. So moving her, I told her, I said, see, you are 6.7 thereabout, and I can get you 3.45 variable rate. Okay? This 3.45, how does this sound? She was jumping and she said, Habiba, just lock me in. I said, one thing about variable I have to explain to you. It fluctuates. How is your risk level? That is the first question. How do you take risk? And she said, I said, don't jump into it because of what you're saying now. She now told me, she said, I'm comfortable. Said, increase, second increase, then I'm going to lock you in. So just for me to know that it's not going as high as going towards the 6% thereabout. So I now told her, let's do this. By the time we restructure our income, the interest rate, she's paying half of what she was paying before. And that is one thing I said, are you ready? Readiness is very, very important. So by the time we now moved into that 3.45, she sees that monthly payment is low, and she sees that the principal and interest that she's paying is almost equal. And at the end of the day, she was now paying below $1,000, 900 and something. That is bi-weekly, $900. So monthly, she's paying around, let's say, close to 1,850 thereabout. So she now said, no, I'm good with this. If you take 1,850 from 21, it's maybe around $400. And she now told me that $400, because I'm comfortable enough paying 2,004 or thereabout, I will actually be putting it into my principal. And I said, that is perfectly okay. Because why? You want to help yourself. By the time you're putting into your principal, you're reducing your amortization. And you know one thing I did for her? I said, you know what? I want you to be just a mortgage with ease. I said, 25 years, your amortization is actually 30 years. And she got her mortgage 2 years ago. I said, you know what? Let's go back. Let's see if we can get the 30 years again. Although they won't push you to 25 because you are not on a 25. I moved her to 30 to just lower it, even though there's going to be an interest that is going to incur. But I said for that, you have to be paying extra on your principal. That is when she started paying 400 extra on the principal, and which really helps. I said you won't see your amortization now. By the time you want to renew in another maybe 5 years, then that is when you realize how much you have paid on with the 400 and how much it has dropped your amortization.
Yeah. So you're absolutely right. The money she's paying in helps in two ways. First, it puts more money into the account, right?
Right.
Therefore, reducing the actual loan balance itself.
Right.
But that's not the only thing. Now, because it does that, it also reduces the term for her.
Right.
So instead of that 30 years, she can end up paying up in 25 years eventually.
Yes.
One good method that I think I have used before, right, is that because you can pay that bi-weekly, bi-monthly, just increase it, or you can actually put lump sum.
I want to say
Let
that.
me show you. Let me share with you how we use AjoPro to do the lump sum. So let's say this person has $500,000 loan, and this person says, yes, I have ability to put in extra 500 bi-weekly. That's nice. What that person needs to do is put that 500 extra bi-weekly in AjoPro for 1 year. Maybe that time gives you 20,000, right? At the end of the year. Now there's something called back-to-back in AjoPro. It's a feature that gives you times 2 of your money. Now you have done 20,000, take extra 20,000 up front. Take that money, 40,000, put it in your mortgage. If you do that for 5 years consecutively, no matter how big that mortgage is, it will crash.
Yeah.
It is something that I've done physically, that I've seen the way it works. If you're able to do that for 5 years consecutively, no matter how big your mortgage, it will crash.
Yeah.
And once the mortgage crashes, more money that you are paying goes into principal than interest. That's when you see the mortgage just closing down as if you are done in magic, right? So she can actually, because the money she's going to pay to AjoPro as a cost, right, will be so insignificant than the amount of interest she's going to reduce if she does that back to back.
And another thing is, you learn every day, right? There is one client that told me, Abiba, I love tax season. I said, why? He said, my tax returns back on my principal, that every year. Sometimes I get 5,000, sometimes I get 8,000, sometimes I get 10,000. I put it back on my principal. You know what? You can do the double the amount. For you to pay back on time, like Mr. Akeem said, you can do lump sum. Lump sum means that, oh, they can give you, it depends on lender, 15% or 20% of the purchase price. So you have access to almost like 50,000 in a year to put back into your mortgage. You can do a lump sum. I have someone, he does lump sum. He does double the amount.
I do the two.
See, chairman, he does lump sum. They double the amount. He will now do accelerated bi-weekly.
A week.
Accelerated.
Accelerated.
Other language, accelerated.
So
Okay.
accelerated bi-weekly, when you calculate the amount, it's not that much, maybe $70. Maybe $70 bi-weekly.
So it pays extra one payment for you.
Exactly. That is extra two payment for you. So when you're looking at this, okay, now tell me, they will see Indians. They will tell them, oh, Indians. I have someone, he's an Indian guy. He said, I paid my mortgage in less than 10 years.
Yeah.
That is what they do. He said, your people sit on the mortgage, but we take the mortgage off our hand. That this mortgage, I want to pay within 10. I said, since then, my head said, I'm not going to sit on my mortgage.
My first mortgage was paid off in 7 years. Right. So
My
the
God.
the idea is a very powerful thing, to be sincere.
Mhm.
You will not know that you have money until you pay off your mortgage.
Yeah, true.
Believe you me, the biggest investment we have is our mortgage. Imagine an average person pays like 2,000, average 2,000 every month for mortgage. So imagine you don't have mortgage. That's extra $2,000 for you.
Yeah.
That's a lot of money.
So
So even though I
Mhm.
don't encourage people to pay it off, it's not financially savvy, but pay it to the level where it does not give you any concern. You are owing 100,000 in mortgage, you are owing 50,000. It's not a concern.
Yeah.
You can even go and spread. So I'll tell you another thing that I've been doing recently. I think is people can learn. When you have your mortgage a range of 70,000, 100,000, and you have a business that you are doing, your mortgage can fund your business. So you can go to the bank and say, okay, I'm owing you 50,000. I need 300,000 for my business. Refinance the mortgage for 30 years. Maybe you are just paying $400 for that. The interest you are paying on that mortgage maybe is 3%, like maybe 3% or 4%, and your business can give you 10%. Why don't you put that 300,000, put it in your business? Let your business give you 10%. You pay the bank 4%.
Yes. And another thing that you can do when you're talking about refinancing, you can do something we called home equity line of credit.
Yeah.
HELOC.
Yeah.
Right? So HELOC is beautiful.
Mhm.
If you have, but I've seen 5%, and then they will tell me, I want to do HELOC. I said,
It's not for 5% now.
no. I said, I'm sorry, but I don't want to be rude. Go and sit down somewhere. Because
Yeah.
it's not, they don't have equity on the house. So what do you want to take out? Because initially, you pay CMHC 4%. Imagine I'll do a small one, 300,000 mortgage. You said 5%. That is what I want to do. 5%. When you take 15,000 from 300, remaining balance is 285. 285 is your first mortgage. But remember, CMHC said, no, we are coming into the picture. They will now add extra 4% on top of it, 11,400. Now tell me, 11,400 has sucked up your 15,000. How much remaining? 4,600. When you see that, then you don't have any equity and you cannot even do any HELOC on that house. I did someone an application. This guy, their house worth 750. Okay? They did a refinancing. Refinancing is I want to take money out of my equity in order for me to. And we did appraiser. Appraiser comes to 750. The remaining balance on the house is around 300 and something. So what we now did is they can only fund 80% of the appraised value, maybe around
Close to that.
650,000. They now put the two together. HELOC stay here, my mortgage stay here. So they are still servicing the 300 and something for their house. The HELOC, if you take money out, then you will service it. But if you do not take money out, you're not servicing anything. It's there. But they want to use it to now the 200 and something 40,000, they are using it to buy a house paid off.
So sorry to cut you.
Sorry.
I really love the angle we are going in this. I thought we were going to have part two of this discussion because we've not even touched the main questions. But the podcast is already very, very interesting and it is so heated. And even me myself, I'm even coming up with more questions as a result of the way we are going. So our time now is like 10 minutes before it becomes 1 hour. But I really, really, really enjoy this whole discussion. In fact, I'm going to be downloading this podcast so we can share it, because the information that has been shared this evening are real life information, like I said. I will call this one the math of mortgage loan payments, meaning anybody who has a mortgage or is planning to buy a house, they should listen to this particular aspect of this podcast and follow every single thing that has been mentioned here, step by step. So at the end of the day, they will end up winning, not sitting on their mortgage, but paying it off like Mr. Akeem paying his own 7 years, because that's actually very, very interesting. I actually love smart what's it called, payments. So now with the 9 minutes that we have, I would like us to wrap up what advice you have for our listeners and our viewers. I will start with our AjoPro, then Mrs. Habeebat. Thank you.
So thank you so much. I mean, for me, I always tell people to be intentional, right? If you don't plan, that's like it's either you are. Somebody said you are always planning. It's either you are planning to fail or you are planning to win, right? If you are going to get into mortgage, whether from investing side or from buying a house, you should be really intentional about what you want to do. Even the scripture says, how many of you will buy a house and not first of all sit down and count the cost? Right? So sit down, count the cost. How much will it cost me in interest? In 25 years, how much will it cost me? How much is my own income that I'm making? How can I reduce the interest that I'm paying? How can I take advantage of understanding, learning, meeting my mortgage broker to explain things to me, to let me understand what I'm getting into, right? Don't also buy mortgage because somebody bought a mortgage. You don't know who that person is. Don't buy because my friend bought a house of 1 million. I want to buy a house of 1 million. Don't do that. You don't use your financial life to play kites. Be serious with your financial life. Understand that money is a slave, and you can't treat it as a son. Any savvy person that understands money knows that money is a slave, and you have to treat it like a slave. If you try to treat your money like a son, it's going to really deal with you. So that would be my final advice for everybody. Thank you so much.
Thank you so much. Thank you. Thank you so much. That's a very beautiful summary. Thank you so much. Thank you, sir. Yes.
Hearing that money is a slave, just don't treat it like a son. Thank you so much for that. Honestly, to me, he has said it all. It's just about planning. Planning, get pre-approved. Don't just jump into it. Sometimes you want to have your shower in a normal life. You want to feel the water first before you just put your body into it because you don't want to get burnt, right? Test it. Learn. All these podcasts and things to learn from is very important. Prepare you, and like you said, don't because my friend just did this, I have to. I've seen a couple of people like that. So we have to be mindful of that. And please don't go ahead and buy a car before your mortgage, because car can reduce your pre-approval between 80 to 100,000. At the end of the day, you'll be stuck and you just be like, bank said I can, or my broker said I can only be approved for 200. You need to plan, and your down payment, oh, you cannot use your line of credit to pay your down payment. You cannot use a loan to service a loan. So you have to be mindful. Sit with a mortgage broker like myself. I'll put you through and I'll educate you on what to do, even if you're not yet ready. Just let's talk about it like we're doing right now. Planning, preparation is the key. So let's learn, because information is key. And when you have the right key, it goes a long way. Yeah.
Thank you so much. I have two wonderful speakers who have actually educated us today, and they are still going to come back again because we've not touched the main questions of today. But so far, the ones that has been given to us, they are going to be really, really helpful. So thank you for coming on the podcast tonight. I remain your host, Udodiri Elizabeth. So I will see you, my wonderful speakers, in another part B of this podcast. Thank you.
Thank you so much.
Yes, thank you
so much for having us. Really
Yes.
appreciate.
You're welcome, sir. You're welcome, ma.
Thank you, Madam
Thank you.
Habeebat, for all the knowledge that you share.
Oh,
These are knowledge that I have to go and write down and start practicing now.
yes, I'm here too. I like the last word. Oh yeah, money is slave. We'll start treating it like a slave,
Not a son.
not a son. Thank you, sir. Thank you so much.
All right. Have a
Really
good
fun.
night.
You too. Take care. Bye-bye.
Bye.
Bye, everyone.